Dogs of the Dow returned a compound annual growth rate of 10.2% versus 7.6% for the S&P 500 over 25 years. That's decent alpha, but it's not the story. The Sharpe ratio of 0.693 versus 0.322, more than double, is the story. Half the market's risk, 87% of the upside, and 5 minutes of work per year. The universe is the Dow 30 current composition applied historically. We acknowledge the survivorship bias explicitly. GE was in the Dow from 1907 to 2018 and should appear in earlier years, but reconstructing point-in-time membership for every rebalance date is complex. Most published dogs backtests use the same approach. Results may be slightly optimistic. For non-US markets, we generalize by taking the 30 largest stocks by market cap at each rebalance date as a blue-chip proxy. The signal is simple. Rank 30 Dow stocks by trailing dividend yield and buy the top 10. Equal weight, annual rebalance in January. No scoring, no multi-factor combination. Just yield. We chose equal dollar weight over the Dow's traditional price weighting because it's cleaner for backtesting and gives each dog the same portfolio impact. Size tiered transaction costs apply, but Dow stocks are almost all mega caps, so the effective cost is around 0.1% per trade. With typically 4 to 6 trades per year, total annual drag is under 0.1%. Simplicity keeps costs negligible. The DAWNT strategy is contrarian. The highest yielding Dow stocks are the ones that have underperformed recently, pushing their yields up. Buying them bets on mean reversion among blue chips. The underlying logic: Dow companies don't stay down forever. They have the scale, brand, and cash flow to recover. O'Higgins popularized the strategy in 1991, and it survived decades of scrutiny because the mechanism is structural, not speculative. The Dow's built-in quality filter matters. These aren't random high-yield stocks. They're 30 of the largest, most established companies in the US. You're much less likely to lose money permanently than in a broad, high-yield screen. Though dividend cuts from individual dogs do occur and can be painful, the simplicity is the point. Complex multi-factor models might squeeze out marginally better returns, but they introduce parameter choices that may not hold up out of sample. DAWNT asks one question: which blue chips are cheapest relative to their dividend? That question has worked for over 3 decades. Here are the numbers from 2000 to 2025. $10,000 became $114,000 versus $63,000 for the S&P 500. The total return nearly doubled the benchmark. But look at how it got there. Volatility of 11.9% versus 17.5%. Maximum drawdown of 19.7% versus 34.9%. Beta of 0.52 means when the market moves 10%, dogs move about 5%. The Sharpe ratio of 0.693 means that for every unit of volatility you accepted, dogs paid you more than double what the S&P 500 did. The Sortino ratio of 1.592, which only penalizes downside volatility, is nearly 3 times the S&P's 0.556. Dogs don't just smooth the ride. They smooth it by protecting the downside specifically. Down capture of 14.2% is the standout number. When the S&P 500 fell, dogs captured only 14.2% of the loss. Up capture was 87%. You get most of the upside with a fraction of the downside. In every year the S&P 500 lost money, dogs did better. 7 for 7? 2022 is the standout. The S&P lost 19%. Dogs gained 6%. A 25 percentage point swing. The dot-com bust showed similar resilience. Dogs returned 12.2% in 2000, while the market fell 10.5%, then held up through 2 more down years while the S&P lost a third of its value. The 2008 financial crisis was the one year dogs took a real hit, falling 19.7%. But even then, they fell roughly half as much as the S&P's 34.3% decline. Every crash in 25 years, dogs cushioned the blow. The pattern makes sense when you think about what dogs actually are. These are dividend-paying blue chips that recently fell. After a market crash, institutional buyers come back to these names first. They want income, they want stability, and Dow stocks offer both. Dogs recover faster because they're the first stocks that large allocators want to own again. Dogs work best after market crashes when high-yield blue chips recover first as institutional buyers pile in for income and stability. They work during inflationary periods because dividends grow with earnings while fixed income loses purchasing power. And they work in flat markets when the index goes nowhere but dividends provide returns. DOMS is a value strategy wearing a dividend costume. When the value factor works, dogs work. The cost of protection shows up during growth manias. In 2019, dogs returned 20.0% versus the S&P's 32.3%. In 2020, negative 2.2% versus positive 15.6%. In 2021, 20.6% versus 31.3%. In 2023, 6.5% versus 26.0%. The 2019 to 2023 stretch was painful. Tech and growth dominated. Dividend-heavy blue chips got left behind. You're giving up participation in bull markets to get protection in bear markets. Over full cycles, the math works. The Sharpe ratio proves it. But you have to stomach years of underperformance. The 52% win rate means 13 of 25 years beat the S&P, barely better than a coin flip on an annual basis. Dogs don't need to win more years. They win by losing less in the bad years. The risk-adjusted return, captured by the 0.693 Sharpe, is more than double the S&P's 0.322. DOMS has a higher Sharpe than QARP, our quality at a reasonable price screen, with comparable raw returns but lower volatility and shallower drawdowns. The effort to risk-adjusted return ratio is the best of any strategy we've tested. 5 minutes per year, half the market's risk, 87% of the upside. We tested on 13 exchanges worldwide. India's Bombay Stock Exchange returned 14.6% compound annual growth rate with 3.2% excess versus Sensex. Japan beat the Nikkei by 2.8% but trailed SPY. Sweden had the best Sharpe outside the US at 0.342. Thailand, Canada, and Hong Kong all underperformed. Emerging markets with less efficient pricing showed stronger mean reversion signals. Only 30 stocks means limited diversification. If 3 dogs are all energy stocks and oil crashes, you're overexposed to a single sector bet. A dog that cuts its dividend destroys the thesis. The stock drops further on the cut, and the high yield that put it in the portfolio disappears. Survivorship bias from using current Dow composition means results are slightly optimistic. Companies removed from the Dow after poor performance don't appear in our historical screens. The strategy also can't participate in innovation-driven rallies. High-yield stocks are by definition not the growth leaders. During prolonged tech dominance, the Sharpe ratio advantage doesn't compensate for the raw return gap. DOGS is a risk reduction strategy that happens to generate alpha, not an alpha strategy that happens to reduce risk. That's what the data shows across 25 years and 13 exchanges. Full results, charts, and the backtest code are on the blog. Link in the description. Find this year's Dogs of the Dow at setaresearch.com/data explorer. Full code at github.com/setaresearch/backtests. Subscribe for more backtested strategies every week.